Hi, this is Bryant Sikorsky. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. I typically help individuals and small business owners solve complex financial problems or financial decisions. This may take the form of some type of planning like financial retirement, retirement income, educational savings, or insurance. On the investment side, I handle stocks, bonds, and mutual funds. And finally, third, if you want to call it client education, because we're in a changing world with changing and changing rules. It's always upon me to keep my clients up to date on changes in the industry, changes in products, or changes in their own lives that are the best solution for them. At the moment, you can see here my website, Wealth Partners, and a love sailboat here. Just wanted to pass along that I am recording this webinar, and I will be copying it to my YouTube channel when it's done. I'll be working from this publication here where it says LPL Financial Research's Midyear Outlook Fundamental. And so if you want to get a hard copy of this presentation that I'm going to be going through, you can download it there. And once I'm completed, you'll see on my website at bryantsikorsky.com, in the upper right-hand corner, there's a little YouTube icon. And if you click there, that's what will take you over to my YouTube channel. And you'll be able to watch this video as well as any of the other videos that I've hosted for you. And with that, let's get started. You can see the title of this publication is LPL Research. LPL Research is essentially my broker to whom I look for research advice, investment advice. They also handle, LPL itself handles any client accounts, any monies, and any securities. So LPL Research puts out two major publications and presentations a year. One is the Outlook for the year, and the second is the Mid-Year Outlook. So as we take a look at this, we reflect upon the fact that the halfway point of this year, 2019, the U.S. economy has held steady, supported by the fiscal stimulus we have highlighted for nearly 2 years, and corporate profits continue to grow. At the same time, trade tensions are increasingly weighing on the economic outlook, while slowing global growth and political uncertainty have forced global central bankers to extend extraordinary levels of support. We're still navigating a challenging environment. Investing comes with uncertainty, and market volatility can be very alarming, but we continue to encourage investors to look beyond term market stresses and consider the real drivers of investment returns, as we believe that mindset may be key to achieving long-term financial goals. This mid-2019 provides updated views of current fundamentals and the things that should persist as longer-term concerns fade, and emphasizes our 4 pillars of fundamental investing: policy, the economy, fixed income, and equities. As the headlines change daily, look at these pillars in LPL Research's Mid-Year Outlook 2019 to help provide perspective on what really matters in the markets. So we believe the fiscal stimulus from the Tax and Jobs Act of 2017, along with decreased regulation, increased government spending, will very much continue to support the U.S. economy in 2019, and that the potential impact is both larger and more durable than consensus expectations. At the same time, uncertainty around global trade continues to dampen the benefits of fiscal support and may be discouraging productivity. Enhancing capital investment. Still believe self-interest is likely to bring the US and China back to the negotiating table, but until we see progress, trade tensions remain the primary risk to our forecast. While fiscal policy has taken the lead, monetary policy grew more supportive in the first half of 2019. The Federal Reserve indicated earlier that it had and would likely hold on raising interest rates for the rest of 2019, particularly in response to the market's poor reaction to last December's rate increase. Inflation low, global growth slowing, and trade risk still present, monetary policy may be too tight for the current environment. Even if not fully justified by the data, the Fed may choose to lower rates later this year to provide a buffer against increased uncertainty. Fiscal stimulus via the tax cuts and job 2018 provided a boost to economic activity in 2018 through tax relief to consumers. We still believe that the fiscal support from the act will exceed consensus expectations this year, and fiscal policies contributions to real GDP growth should be around 2.2% for 2019, higher than the 1.3% contribution in 2018. Although there is a strong for treasuries now, that demand may wane as inflation nudges higher. Global investors begin to demand more yield than the rising federal budget deficit. We do not believe legislators or global investors fully appreciate the long-term risk of the rising deficit to domestic rates and the value of the US dollar, adding complexity to the policy outlook. Fundamentals have continued to support but moderate economic in 2019. Financial markets were more skeptical at the end of last year, and recession calls were amongst the loudest they'd been all cycle. So far, though, this outlook has failed to materialize. The U.S. economy grew at 3.1% for the first quarter, though some underlying weakness in the data may foreshadow some slowing later in the year. Net exports and inventories contributed nearly 1.6% to headline growth, but strength in both components typically weighs on GDP in future quarters. Nonetheless, weighs on domestic demand held up well in the face of a government shutdown and trade headwinds. Consumer spending was a modest contributor to GDP, while business investment slowed, still posted growth. With the Fed on hold and fiscal stimulus in place, we believe fundamentals are supportive of continued moderate GDP growth this year. However, progress on several trade issues remains central to our growth projections. Negotiations stalled in the second quarter. We've slightly reduced our 2019 GDP forecast to 2.25 to 2.5%. Even if we should see growth slow, the U.S. job market continues to be a bright spot. Hiring has continued at an above average pace for the expansion, and weekly claims for unemployment benefits have dropped to cycle several times this year. Strong job growth leads to higher incomes, stronger business and consumer spending, and improved corporate profitability. Productivity growth, though, is the key to sustaining this virtuous cycle. We saw a glimpse of this in the first quarter as productivity grew at the strongest pace since 2010. Fixed income investors have benefited from falling rates due to subdued consumer inflation, a pause in rate hikes, and demand for U.S. Treasuries. Although a flat curve has been troubling for some investors, we believe the flatness is due more to global investors searching for better yields than it is an indicator of looming recession. Considering the Fed, inflation, and our expectations for progress on trade, we now look for the 10-year Treasury yield to reach the 2.5 to 2.75% range within the next 6 to 12 months. Fixed income investors must be selective when considering international bonds given the various challenges in global policy and growth. Fixed income investors has benefited from falling rates due to subdued consumer inflation, a pause in rates, and demand for U.S. Treasuries. Although a flattening yield curve has been troubling for some investors, we believe the flattening is due more to investors searching for better yields than it is an indicator of looming recession. Considering the Fed, inflation, and our expectations for progress on trade, we now look for a 10-year Treasury yield 2.5 to 2.75 range within the next 6 to 12 months. Currently, we favor an emphasis on investment-grade bonds, fixed income allocations, with a focus on a balance of investment-grade corporates and mortgage-backed securities. We believe the extra yield in the mortgage-backed security market, given the degree of risk, remains attractive, and economic growth continues to support investment corporate bonds. The mid-year market turbulence has been uncomfortable, and it may not be over. Several market risks are still present, including the geopolitical environment, the possibility of failed trade negotiations, and a potential monetary policy mistake. These risks fuel periodic bouts of volatility with trade central to our outlook. The overall U.S. economic picture has supported continued expansion. Modest inflationary pressures help boost demand and support corporate profit margins in the first quarter. Given solid fundamentals, we continue corporate profits will exceed current consensus expectations. The Fed's decision to pause interest rate hike boost sentiment and increase demand for equities. Market technicals provided support for stock rebound earlier this year, and higher historical patterns suggest the possibility for strength throughout the remainder of the year. We have slight preferences for large company, large cap over small cap, value over growth, emerging markets. We continue to lean cyclically, favoring industrials, financials, and technology. Market valuations remain favorable with the S&P 500 index's forward 12-month price-to-earnings ratio within historic norms. We reduced our S&P 500 earnings per share forecast to $170 for year-end 2019, mainly because of trade uncertainty, and our year-end S&P 500 fair value estimate remains at $3,000. We will visit this forecast. Clarity on trade and monetary policy results in an improved outlook for corporate profits. These are disclaimers or qualifiers about this presentation. So with that, I will say thank you very much for as a reminder, don't forget, if you'd like, to go to my website at bryantkorski.com. You can scroll down here and you can obtain a copy of this presentation, which I just more of a read-like format as opposed to a PowerPoint. And if you want to watch the presentation which I've recorded, again, click on the YouTube icon here on my website, and it'll take you right to my YouTube channel. And click on videos, and you can see all of the different webinars that I have hosted, recorded, and uploaded. So with that, I'll say thank you very much, and I hope great rest of your